if you're selling to diversify, you may be investing in a more broadly diversified portfolio that can grow your wealth with potentially less risk. So if you can acknowledge that FOMO and move beyond it, it can be a powerful way to still allow your wealth to grow with a little bit less risk. I think another big thing is the tax issue. You mentioned we won't really be diving into that today, but I think there is a resistance to selling stock because people just don't want to pay the taxes on the gains. We call this letting the tax tail wag the dog. We love our dogs here at Monument, but we don't like letting taxes be the driving factor. And a narrow focus on taxes can come at the expense of really maximizing opportunity and optionality when it comes to your stock-based compensation. You hit on this a little bit, Jessica, but I think a fourth big one is mental accounting, which is just the propensity for people to allocate money to very specific purposes. I think we hear this a lot in our discovery meetings. People will say things like, oh, when this stock vests, I'll have money for my kids' tuition.
Right.
Or this tranche will cover my down payment on the beach house we're planning to buy. So mental accounting can lead many executives to not do the proper planning for funding near-term goals that are important to them, which is especially risky when the value of your stock-based compensation isn't guaranteed and can be influenced by forces outside of your company. But when you have these mindsets, I don't want to miss out on gains, I don't want to pay taxes, you miss seeing the big risks you may also be taking, particularly concentration risk. So a lot of these things lend themselves to concentration risk, which is essentially the risk of amplified losses that may occur from having a large portion of your portfolio in a particular investment. And Jessica, I love, you've given people really simple advice on how to assess their concentration risk. So could you share the little mental exercise that I've heard you talk about?
Yeah, this is just a rule of thumb, but it's a great place to start if you're not sure what to do. Just do the math. And by that, I mean add up your entire portfolio. So that's your taxable investments, your retirement accounts, company stock. Don't include your house. And what percentage of that total portfolio is your stock? At Monument, we generally like to see a client's company stock be no more than 10 to 20% of their portfolio, depending on their risk tolerance, their risk capacity as well. So just start by doing the math for yourself. And if you find that your company stock is more than 10 or 20% of your overall portfolio, that's usually a sign that you should be thinking about, okay, how am I going to exit this stock in light of all those things that you talked about, right? With the taxes and the fear of missing out on future gains, kind of all those mindsets of keeping those in mind. It's still a good temperature check for you to be like, okay, this is like a quantitative way for me to tell I need to start thinking about selling stock.